Oh man, you're gonna want some anti-venom for this one. Folks, I need you to understand this particular chart right here. This is a very, very, very important one, okay? Look, global equity positioning. In English, stock market is at a relative low going all the way back to 2011 when you consider volatility and standard deviation measured by a z-score. Okay, the last 10 words I said, just ignore them. Basically, things bad, okay? So this chart, in very, very simple terms, tries to look at how much movement we get up or down from a baseline. So this isn't relative. It doesn't mean that right now, because the line is at the same place as it was in 2011, prices are the same. It's just a relative stretch. How far down have we gone relative to sort of a normal trajectory? And when you look at this, we've deviated about 2 standard deviations, which is like a 95% deviation for those mathies, from the norm level. Now, what's remarkable about this is if you actually chart it across other deviations to the upside or the downside, take a look at where we land right now. This summer and where we sit right now, these 2 points over here are essentially the lows that we experienced during the Q4 2018 sell-off, the COVID pandemic, although that one went and stretched a little bit further. You could see actually that one went almost halfway to a 3rd standard deviation, which is crazy. That'd be like 97.5% or more. But anyway, then you've got the summer of 16 pre-election sell-off over here, and then the bearishness in September of 2011. And so this really shows you that we are seriously at a painful level. Now, when you compare it to sort of the upside in terms of when we get 2 standard deviations to the up, you could see the more euphoric periods like Q1 2021. Even though we had a November boom over here, we actually didn't deviate that much in a standard deviation term. Growth in other cycles over here like 2017 boom. Anyway, the point of this is to say that the level of drawdown that we are seeing in the NASDAQ or the S&P 500 right now is relatively severe. It brings us back to prior years that, were also pretty painful. And if you go over here and look at the NASDAQ on Webull, and you use the monthly chart, okay, this is a nominal chart, so it's kind of, obviously numbers on the right are going to look a lot more dramatic than over here. You'd have to change this to exponential to kind of smooth this out a little bit. But the point of this is to say that if you go back to the COVID crisis, you're really sitting at the red bars here. And you go back to the Q4 2018 sell-off, you're looking at over here. Now again, exponentially, these are gonna look like a lot bigger of drops. But the reason I'm using this chart is because I wanna show you that this here was 4 months of red on average if we sort of use the averaged candlesticks. Over here, the average was about 2 months of red. Look at the months of red that we're experiencing here with the averaged candlesticks. January all through essentially now with the exception of August. It shows you just how long this has been going on, this pain. The last time we had that length of pain was really over here in 2009, where you had, if you include some of these over here, including this one green shoot here, 1, 2, 3, 4, 5, 6, 7, 8, 9. That's really the last time you experienced this much pain. And then, of course, if you go all the way back to the .com era, I mean, this is when you experienced twice as long a pain as what we are experiencing now. That's pretty darn devastating. But anyway, looking at this particular chart here, it does suggest that on a standard deviation metric, we should be, no guarantees, pretty close to the stretchiest point that we could get in terms of pain to where we should be rebounding back, and the bottom can't be far off from here. But then again, we can't make any guarantees because if these levels become normal, and this is where this kind of chart could be misleading, right? If these sell-off levels where we are now become normal, then they're no longer a standard deviation from the norm if the trend drags down. So you could trend lower. It's just in the recent period of time, how much pain we've had suggests that we should be relatively near a bottom. But unless that trend, if that trend changes to the dark side, all bets are off. And so this is actually leading now to an increase in the chances of retail capitulating. I thought this was a really interesting chart. There's Vandatrack puts together this capitulation index, and they believe that retail investors have recently had a spike in the likelihood of their willingness to capitulate. When this sell-off started back in January and December, we were really only here, maybe about 43% likely to see retail capitulation. But now we're actually somewhere here closer to about 55% likely to see retail capitulation, which isn't like the peak we saw in June when we last revisited these numbers, but it's rising. So the odds that retail ends up folding are going up once again. And that's creating some more fear that, if we see retail capitulate, first of all, it's probably a big buying signal, but it also means that people have finally had it and they've reached that peak pain point. And there are a lot of market strategists that say the only way we actually end up getting out of a bad market is when retail capitulates. So some people are like, please retail, just sell already, because that's the perfect time for us to acknowledge, okay, we've hit the bottom, since retail usually sells at the bottom. At least that's what they say about retail. Okay, so as much as any individual investor is retail, like you're watching this, I'm watching this, we are retail, right? An institution would be something like an exchange-traded fund or a hedge fund, right? Those are institutions. Anyone who's an individual is retail. Even if you work for an institution, if you're trading personally, you are retail. So it's just worth noting that we're all part of that retail bucket. So now, what's also interesting is, I don't know what it is with retail, but they have this thing, people have this thing of buying stuff when it skyrockets. And so here, for example, is purple stock, okay? I bought purple at like 18 bucks, which I know sounds crazy, but I sold it at like 24 after it ran to like 30. It was crazy. Their sales were amazing during the pandemic, and like many other things, totally evaporated. I'm glad I sold, told everyone I sold. Unfortunately, since then, it's gone down to like $2.60, which is absolutely insane, right? But take a look at this. It had a 40% update, followed by a 0.5% update, followed by a 4% update, followed by a -2 and a -2% day. Yet, with this kind of performance, all of a sudden, this stock shows up as, of course, a hot retail stock with not only the price change, the higher you are on this, the higher the price is moved, not only the price going up, we just saw that on the chart, but also retail dip buying up. So the more to the right you are, the more retail is buying. And so, of course, if a stock goes up, retail just swarms in. It's pretty remarkable. You know, there's even this evil thesis that evil institutions, which is possible, purposefully write narratives on like Reddit on like low liquidity stocks, potentially like purple, trying to get threads to go viral, and they use bots to kind of like vote them up and pay for awards and stuff. You ever see on Reddit how there are all these like awards and stuff for posts? Well, there's this thesis that hedge funds are paying to do that on purpose to get more attention to these threads. Then people start piling into a stock like like purple, because all of a sudden institutions have written a piece that actually sounds logical, when in reality what they're trying to do is get the stock to go up, short it because they actually don't think it's a good stock, and then when that momentum goes away and it falls, because it eventually always does, then they cover their shorts and profit off of retail by manipulating basically areas like Reddit with a lot of money and awards for posts and stuff like that. So it's kind of interesting. But anyway, if you go back over here to this retail chart, you can really see that retail right now is interested in not only purple, but also Netflix, which is fascinating because they've always been sort of the canary in the coal mine for bad earnings. Google's over here, Tesla, Shopify, Redfin. I have no idea why you would be buying Redfin right now. Enphase, love that one, but it's going to hurt in the housing market. Costco, Apple, Amazon. Kind of interesting. You've got some selling over here, actually. Sunrun, Uber, and so on. Arrivals over there. SunPower as well. So anyway, okay, so then we've talked about these standard deviation moves. We've talked about retail capitulation, what retail's buying. There's another really important thing that we have to talk about, and no, it's not that this 30th, which is this Friday, the courses on building your wealth have a price increase. And if you want to join me for fundamental analysis, we just did a Google fundamental analysis this morning. We're probably going to go a little bit deeper into Google once their next earnings come out. Or even deeper, but we've already set up the stage for what to look for and what kind of weakness we're expecting for Google. So if you want to be part of those or real estate analyses, make sure you join those live streams every day the market opens up. Join any of the courses and you'll have access to those, plus lifetime access to the lectures on building your wealth. And do remember that this 30th, we also have House Hack that has an expiration for the 55% warrant bonus or 65% bonus if you're a course member. If you're not a course member yet and you want that 65%, just buy one of the courses and then you can fill out your DocuSign and subscribe. Just make sure you know this video is not a solicitation. You have to go to househack.com, read the PPM, make sure you read that. It's only one click away. Then go through that DocuSign, submit your accredited investor documentation, and we'd love to have you on before September 30th. So that update's coming soon, or that deadline, I should say. So what's the next big problem? Well, the next big problem here is the change in forward earnings per share. And what's fascinating here is you can really see that we are expecting now earnings per share to finally plummet. Now, the market has not really been pricing in a plummet in EPS for, pretty much all of the year, it has felt like. But then again, we did have periods of time over here where we finally had a little bit of pricing in. But really, what this is telling us is we are now potentially getting serious about having the second half of what Michael Burry calls the stock market crash. The first phase of the crash is crushing multiples, right? This is where you say, instead of paying 10 times per stock, I'm only going to pay 5 times times earnings for a certain stock. So for example, if a company has $5 of earnings, 10 times earnings means you pay $50 a stock. If you're only willing to pay 5 times earnings, you pay $25. But if those earnings now go from $5 to $2 and you're only willing to pay 5 times, now the stock's $10. So you kind of get this double earnings compression. And this is why, like, these sorts of write-downs that we're expecting, this compression that we're expecting in forward earnings per share, this is exactly why I want to, as much as possible, be investing in what I believe are going to be more recession-proof stocks. Now, recession-proof stocks are not immune to PE multiples coming down. So keep that in mind. PE multiples coming down, they're not immune to that. They are going to have multiple compression. But what you don't want is EPS declines plus multiple compression, because then you really have pain. And again, that's where I think companies like American Express and Tesla, which are much heavier in than Amex, those are going to survive very well on EPS as long as their margins don't compress too badly. But multiples, there's nothing we can do about that. That's just market-wide pain. Speaking of market-wide pain, you know, I have to say, I cannot believe that we saw Treasury yields do what they did today. Treasury yields, oh my gosh. Treasury yields on the 10-year, folks, just crossed 3.9%, up 20.5 basis points today. Dude, what? This is absolutely insane. We're gonna start seeing mortgage rates. Like, it takes a few days for the mortgage rate chart to actually show it. Mortgage rates, if I just Google mortgage rates, always put in 740. 740, 40. There you go. So right now it says the 30-year fix is at 7%. ARM's only 6.5, 15's 6.5, big deal. 7% for the 30-year fix. This is going to skyrocket. Like, I expect that with the 10-year Treasury now at 3.9, this is probably going to go to 7.25 or 7.5. There is no way you're not going to see a crushing in the real estate market. That's why I'm creating the company House Hack. That's why I'm inviting accredited investors to join me and get founder shares in it, because we're going to have the opportunity of a lifetime here to go shopping for real estate. This is insane. But in addition to that, if you want to just park cash, I mean, holy smokes, look at the 6-month Treasury right now. Let's get it. Oh man, 3.9. Let me see if that's accurate here. Yep, it appears to be. CNBC doesn't want to load, so forget them. Anyway, it says, there we go, 3.9 for the 6-month. That's actually relatively unchanged today. And if you go to the 2-year, wow, the 2-year jumped 4.31. So this is where you definitely had some selling today. The 2-year Treasury is at 4.31. That's insane. If you're willing to lock up cash today for 2 years, and not be subject to market risk, you could get a risk-free return of 4.31%. That's insane. Absolutely insane. So anyway, all of this is more pressure on the housing market. Of course, stock valuations definitely hurt on this as well, although the market did not end too terribly today. It looks like the S&P 500 ended up falling about 1%. Well, that's pretty rough. But the NASDAQ only went down about 0.41%. We still have not crossed new lows for the QQQ, worth noting. The QQQ has gotten over here to a low of 272. And we were at 268. So, I mean, we're basically at all-time lows here for recent history. And we were at 360 this summer on the S&P 500. We're at 364 right now, got to 363 earlier today. So pretty wild. We're pretty dang near there to the bottom. But again, if that volatility, or not volatility, the Z-score chart is any guide, hopefully, we are close to peak pain here. Although it's all going to depend on what the Fed does to us. Whew! Get your anti-venom ready. And after that, you're going to want to cheers to a super restore. Sorry, RuneScape jokes. I don't even know if it's a joke. It's pretty much needed right now. I let it sit too long. It's not warm anymore. I mean, it's kind of like lukewarm. It's not that good. Anyway, see you, bye.